Welcome back, guys, to another episode of Mitchell Group Media. Many people are asking, is it a good idea? And if so, how can they unlock equity in their home? Today, we'll talk about refinancing, a HELOC or home equity line of credit, a HELoan or home equity loan, and a HEA or home equity agreement. So what does it mean to refinance? Is it the right time for me? And when should I do it? Before we dive in, be sure to like and subscribe so you can circle back to this video when needed. Refinancing your home is a significant decision, and you should always understand your options and when it makes financial sense. People refinance for different reasons, sometimes for a better rate, as we saw a lot happening in 2021. A more favorable rate can occur when you're currently at a variable or fixed rate. In this situation, refinancing could reduce your monthly payments and the total amount of interest that you'll pay over the life of the loan. If your financial situation improves and you want to pay off your mortgage faster, shorter loan periods usually result in more favorable rates as well. Then there's the cash out refi. You may or may not be getting a more favorable rate, but you need to access equity in the property. Cash out refinances generally have a slightly higher mortgage rate than a non-cash out refi because of the risk associated with that. It is important to know whether or not you started the mortgage at 80% loan to value and whether or not you're going to be within those parameters when you refi. If you don't maintain that criteria, you will be forced to pay mortgage insurance. So keep in mind, depending on the loan, what that's going to mean over the life of the loan. For those of you who may have refinanced when the rates dropped, you quickly realize the process was just as grueling as the initial mortgage because it completely replaces your current mortgage with a new loan to provide you with that new rate and terms, and there are closing costs associated with that. The average closing cost on a refi is approximately $5,000, but the size of the loan, the state, and the county will all play a role in determining that figure. Be mindful of no-cost refinance advertisements, as you will probably be charged a higher interest rate and rolling the closing costs into the loan, which may cost you more over the life of the loan. If you plan on buying discount points to buy down your mortgage rate, you'll have to pay it up front. Buying discount points can save money over the life of the loan, but whether it makes sense depends on your personal situation. Qualifying criteria for a refinance are usually going to be the same for your original mortgage, and the process will take 30 to 45 days on average. What is a HELOC? A HELOC is a home equity line of credit. It allows you to draw funds against a pre-approved credit limit based on the equity you have in your home. They tend to offer competitive rates because they are secured by your home's value, but are typically higher than mortgage rates because they come with more risk. There are several factors that affect the rates of a HELOC, such as your credit score, loan-to-value ratio, and your draw period. The higher the credit score, the lower the interest rate. The loan-to-valuation ratio is a crucial factor, as lenders typically prefer a combined ratio of 75 to 80% when considering both the primary mortgage and the credit line amount requested. A larger line of credit sometimes carry a higher rate. A longer draw may come with higher rates as well. Your draw period is also important when taking into consideration variable versus fixed rates, as a variable rate will start low but can fluctuate, and a fixed rate starts higher but offers more predictability. Many HELOC programs are only variable rates. So why may you want to choose a HELOC over a cash-out refinance? Because you only pay interest on the amount of home equity that you need when you use it, not the entire amount you borrowed, which you pay interest on before you may even need to use it. Because HELOCs are easier to set up than a mortgage, they're typically cheaper with initial fees. Just keep in mind your closing costs, your draw period, annual fees, and how that's going to impact your overall payback. HELOC's closing costs typically range from 2 to 5% of the loan's total amount. Additional fees associated with a HELOC may be for home appraisal, credit report, title search, document preparation, loan recording, notary fees, annual fees, and origination fees. There are two phases with a HELOC, the draw period and the repayment period. During the draw period, you have the flexibility to withdraw funds as you need. Once you enter into the repayment period, additional withdrawals are no longer possible, and you must start repaying the borrowed amount back on a monthly basis. A typical draw period lasts for about 10 years, although durations vary from lender to lender. During this period, you can make interest-only payments on the amount you withdraw, which doesn't affect the outstanding balance of the credit line. The principal amount can be deferred until the start of the repayment period. Once the repayment period begins, you're required to pay back the total amount borrowed plus interest. This repayment typically spans 10 to 20 years and involves variable or fixed monthly installments. Some HELOCs may have both, an initial fixed rate for a term period, then a variable term rate. Now, what are some disadvantages of HELOCs? The HELOC process can take 2 to 6 weeks, but the main concern should be the variable rate. While this introductory offer can mean lower rates initially, they can potentially increase significantly over time, leading to higher payments than anticipated. If you're not sure that paying a variable HELOC rate is best for you, you may find a more suitable loan option in home equity loans, cash-out refinance, or personal loans. Always consult with an industry professional so they can tailor your specific needs and advise you financially on the best course of action. Now, what about a home equity loan or HELoan? Typically, you'll need 15 to 20% equity in order to borrow against a property. You'll receive this type of money all at once. This will be a one-time payment that you will pay back over time at a fixed rate. You pay off this loan in addition to your mortgage, since it is technically a second mortgage and is leveraged on the home and holds a second position to the primary mortgage lien. Be sure to check out my other video to better understand mortgages and liens. The home equity loan process generally takes between 2 to 6 weeks. Some disadvantages here are your home secures the loan. You have to borrow a lump sum, and interest on the full amount will start accruing immediately, and you could use the full amount even if it weren't necessary. Now, what about a HEA, or home equity agreement, also known as a shared equity agreement? An HEA is a tool for the homeowner to access a portion of your home equity by allowing lenders to invest directly in the home. In exchange for a partial ownership stake, homeowners receive a chunk of equity from the investor in exchange for a percentage of future home value. See, when you enter into a home equity agreement with a lender or investor, you're tapping into your home equity without signing on for an interest loan. And in place of this interest, you agree to pay the lender a percentage of your home's increased value in full when you sell the home or at the end of the equity shared agreement term. Typically, a HE loan has a term of 10 to 30 years. At the end of the term, you normally have to buy out the investor share of your home via a cash out refi or a home equity loan. It may or may not be necessary to pay special attention or ask about any possibility of technical default or loss in market value over what is guaranteed or owed with this type of agreement that might not be present in other residential contracts. Whether a shared equity agreement is worth it depends entirely on your individual financial circumstances and goals. Now that you have a detailed explanation on the most common ways of tapping the equity of your home, you can better understand which one might be right for you, if any, and why. Now, if you've seen any of my other videos, you know I don't tell anybody what I think they should do. I provide information and answer questions that are essential to add value and transparency in the real estate market and allow people to make decisions that they feel are best for themselves. I'm not a financial advisor, nor is this or any of my other videos intended to offer any financial advice. With that being said, just remember, it is always imperative to borrow responsibly and within your means. The temptation to overspend easily accessible funds can lead to overborrowing for some individuals, creating a debt that can be challenging to repay, especially if the home value decreases, the property is overimproved, or personal financial circumstances change. While all of these options are mostly available regardless of your location, my broker's license is issued in the state of Florida, and that's where my information comes from and pertains to. If you found any information in this video interesting or helpful, please like, subscribe, and ring the bell so it may help someone else. Thank you. And I'll see you in the next video.